This is the inflection, where structure shifts and everything changes. For nearly a decade, startups were rewarded for one thing: growth, not profit, not resilience, not durability, just growth. Capital was abundant, valuations expanded, and investors didn't ask when companies would make money, until they did. In 2019, two companies stood at the peak of that era, which is Uber and WeWork. Both raised billions. Both lost billions. Both were called revolutionary. But when the environment changed, one adjusted. The other had to renegotiate its existence. The difference wasn't ambition, it was structure. And that's why startups don't care about profit until it's too late. The era that enabled. This before we look at the companies. We need to understand the environment. From roughly 2010 to 2021, interest rates were historically low. Venture capital funds were massive. Late-stage capital flooded private markets. Firms like SoftBank deployed billions aggressively through its Vision Fund. The logic was simple. If capital is cheap, own the market first. Profit can come later. Scale was defensive strategy. In that environment, burning money was not a flaw. It was a signal of expansion. But scale built under cheap capital carries an assumption of that funding will always be available. But that assumption rarely holds forever. Uber, aggression with optionality, entered transportation in 2009. It wasn't just a taxi app. It was coordination software at scale. Its growth playbook is enter new cities rapidly, subsidize riders, incentivize drivers, prioritize network density. This required enormous capital, and Uber lost billions doing it. But structurally, Uber remained asset light. It didn't own vehicles. It didn't hold long-term real estate obligations. Drivers were not salaried employees in most markets. Its biggest cost lever was incentives, which means if demand slowed, Uber could reduce subsidies. If a region underperformed, Uber could exit. When capital tightened after 2019, Uber pulled back from non-core experiments, cut costs, focused on path to profitability. It was painful, but it was adjustable. Its aggression was funded by capital. Its survival was enabled by flexibility. That distinction matters. Uber scaled optionality. WeWork scaled obligation. That difference changes everything. WeWork. Vision. Built on fixed commitments. WeWork began with a compelling idea: transform commercial real estate into flexible workspace. It positioned itself as a tech-enabled community platform. But at its core, it was a lease arbitrage business. The model of WeWork is sign long-term leases, 10 to 15 years, renovate and redesign sublease desks monthly at a premium. When occupancy was high, the margins looked strong. At 80 to 85% occupancy, unit economics appeared attractive. But structurally, costs were fixed. Revenue was flexible. That asymmetry is dangerous in downturns. When growth slowed, leases did not slow. When funding tightened, build-outs didn't disappear. When IPO scrutiny exposed financials, the valuation collapsed. Not because shared offices are useless, but because long-term commitments were locked in during a period of optimistic expansion. WeWork didn't just grow, it committed. And commitment behaves differently under stress. Same era, different risk profiles. On the surface, both Uber and WeWork raised billions, prioritized scale, lost money aggressively, dominated headlines. But structurally, Uber scaled through networks. WeWork scaled through fixed assets. Uber's downside was margin compression. WeWork's downside was solvency pressure. That is a fundamentally different risk curve. Growth hides structural weaknesses because momentum masks fragility. As long as capital flows, both look powerful. When capital retreats, flexibility becomes survival. What this means for the next cycle, for entering a different capital environment. Investors now ask, what are your fixed commitments? How adjustable is your cost base? What happens if funding stops for 24 months? Growth alone no longer signals strength. Resilience does. The next generation of startups will be evaluated differently, not just on how fast can you expand, but on what are you locking yourself into while expanding? Because profit is not simply earnings. It is optionality. It is room to maneuver. It is protection against volatility. And when startups ignore profit entirely, they often ignore structure. That works until the environment changes. Growth magnifies whatever structure sits beneath it. If that structure is flexible, growth stretches. If it is rigid, growth amplifies risk. And by the time profit becomes urgent, the commitments are already signed. So the real question is, what structure are we building today that won't survive tomorrow? This isn't about profit. It's about when the structure finally catches up. That's the inflection.